Hey everybody, Tom Gentile. Welcome to my Tom's Trading Essentials. This is a 3-week webinar series that we do a couple times a year, and we're excited to have all of you here participating with us. I am going to be peppering trades throughout this session. All right, so I've got a lot to cover here. I mean, I literally was thinking about taking half this presentation out, but I know all of you guys have understandings of option basics, so we're going to get through those, and I want to show you 2 different trading systems tonight that you can capitalize on, as well as we got a lot we're going to talk about. We're going to talk about really how we do not only just stock selection, but option selection, and just a ton of information for you tonight. Before I begin, real quick, all right, you will have access to this recording, those of you that are live, and I just wanted to mention that if you want to read this disclaimer in its entirety, just hit pause. I'm going to mention 2 quick things before we begin. Number 1, stock and options trading has large potential rewards, but also large potential risk. And number 2, myself, Jay, who's in the back of the room with me, and also any guests that we have on, and I will have a very special guest coming on for week number 3. I'm going to leave him as a surprise, all right? But going to let you know that anyone that we have on here, we are here as educators, showing you how it is that we navigate and trade the markets. We are not investment advisors, okay? That means we don't give specific individualized advice, nor could we answer specific individualized questions, right? That's it. Everything I'm going to talk about tonight is in US dollars, unless I note otherwise. For those of you that are new to me, just real quick, I've been doing this longer than I haven't, okay? So plus 25 years plus. And when I say I've been doing this longer than I haven't, that means I'm over half my life I've been involved in the stock market, one capacity or another. I co-founded Optionetics. This was back in the early 90s. We had over 300,000 students go through our live events, and many of you are on here tonight. You know, I also have had several books on various subjects in the stock index and options markets. I've been on CNBC, Bloomberg, Reuters, Fox, and more. Not lately. I mean, I did a CNBC Asia not too long ago, but I tend to not want to be part of the Hollywood squares, because that seems to be the case for a lot of these folks that go on TV. I don't have time for it. I'd rather spend my time with you. Most of you know me as the founder and editor of TomGentile.com, TomsOptionTools.com, Optionetics.com, as well as others. And a big welcome back to our Optionetics students, okay? Especially if you're here for the first time. And if you're here for the first time, you know, we're back teaching Optionetics students and teaching Optionetics events again. They are online, however. That's our lifetime reattendance, and we're happy to continue to teach you. All you have to do is just show up. And so we do this a couple of times a year, but in between our Optionetics events, you can find a lot of our short videos on our YouTube channel. Okay, our YouTube channel is youtube.com/TomsTradingRoom. All right, what does that look like? Well, it looks like this. All right, we post several videos up. We do at least 1 a week. Typically, we do 2. And so you can get all that information again, TomsOptionTools.com. Oh, excuse me, YouTube.com/TomsTradingRoom. We also have, and I'll be offering this up to all of our new users, for those of you that used to use Optionetics Platinum. That's now again upgraded to TomsOptionTools.com. I'll talk about that later on. And of course, we do premium education, including mastery and partner programs. And we do that for a small number of folks each year. And it is a mentorship that we do with myself and our trading team. We're finishing up the year, and so I'll be talking about our new mentorship for 2021. I can tell you this: it's going to include 200 live events. It's going to be part of that program we're doing next year, but that's later on down the road. Let's talk about tonight. So tonight, I want to just let you know we're doing these weekly webinars from about 8 to 9. If I go over, my apologies. I want to make sure I give you this stuff, but not ram it down your throat. I need to make sure you all understand this. Right? Recordings, like I said, will be mailed out to you following the live events, and I will include the slide deck. as tonight's handouts, but any handouts that we have, we'll also make those available as well. Our webinar agenda, now my plan was to talk about contrarian trading today, but I found more opportunities in our crossovers as well as the money calendar, so I'm going to mention those. Next week we'll get into contrarian trading, and week 3 review, and we've got advanced charting techniques with a world-known trader. All right, this guy's actually created several different world-class indicators. I believe he has an ETF or 2. This is a big guy. All right, so we're going to bring him on week 3, and you'll be very excited to have him on. We're excited to have him on as a special guest. So let's get started, guys. Benjamin Franklin was well known in saying this quote here: "An investment in knowledge pays the best interest." And with that, the first piece of knowledge I want to teach you, for those of you that don't know, is where we find our tradable stocks. I call these best tradable stocks. Now, there are probably 20 to 25,000 stocks that are available for trading out there if you look at every single one of them. If you whittle them down, like I do, and you look at the 3 pieces there where the best tradable stocks are found, you'll find that it's got to be market liquidity, stock mobility, and short-term optionable. And so what I mean by that is that we want to look for stocks that have that are very liquid, and options that are very liquid. So you want the greatest liquidity in the stock market? Look at the options market, particularly the CBOE, the Chicago Board Options Exchange. And if you go to www.cboe.org, then you're going to look for something called the Penny Pilot List. And that's a downloadable list that anybody listening and watching this webcast can find. In fact, I'm even going to give you an easier way than to navigate through cboe.org. If you just go Google it, Google the words Penny Pilot Program. And when you do that, you're going to find that CSB in the Penny Pilot Program arena. Okay? So again, and I'm just going to show you exactly how to do that. All right? Penny Pilot Program. Let me put the spaces there. And what you're looking for is this right here, MEAX options. Right? Let me turn on the big mouse, meaxoptions.com. And if you click on Options Penny Pilot Program like I just did, it's going to bring you to the Options Penny Program. And all you have to do is just come right down here where it says MEAX Emerald Penny Program Class List. You can download it in CSV or you can download it in Excel. And when you do that, and you click that little thing, it's going to open up. It's going to, for me, because I'm using Chrome, depends on what you use. If you use Safari, if you use Firefox, if you use Internet Explorer, whatever you use, you're going to have this list downloaded. I'm opening it right now just to show you what it looks like. And there you go. This is in Google Sheets, and you can see that it comes up and it gives you the list of the most liquid stocks out there that trade options. Now you can utilize this as your trading list. If you want to bring it down even more, let me show you what you do then. What you can also do is you can look at options that are weeklies, right? Weekly options, and those weekly options that will bring that down, and you're actually looking at only about 325 options. So that's fantastic, but you're Googling Penny Pilot Program to get to that. Now, why do we trade options? Well, why I trade options is because of control. That gives me leverage, all right? The ability to control a large block of stock, which might cost a lot for a much smaller price. It also offers protection on the stock in the form of either, for instance, if I were a put buyer, I could be buying puts against the stock, I could be selling calls against the stock, or I could be buying calls instead of buying stock, and that offers protection in itself. Now, there are also ways of paying for protection, and that would be with vertical, diagonal, and horizontal spreads, which we'll start to get into next week. Okay? I want to keep it easy tonight. All I want to talk about is calls and puts. That's it. Calls and puts only. So we're going to find trades that have some really juicy looking calls and puts in them. There are 2 types of options out there, calls and puts. I'll make it very quick for you because most of you in your room know what this is. When I'm buying calls, I'm bullish. When I'm buying puts, I'm bearish. Calls give me the right to buy a stock. Puts give me the right to sell the stock. As a long option trader, we're not obligated to take the stock. You have rights as a buyer of options. You do not have obligations. Okay. Now, we can buy these. If you buy a call, you're bullish. If you outright sell a call, you're bearish. That's risky. If you buy a put, you're bearish. If you sell a put, you're actually bullish. That's risky too. However, selling puts has a lot less risk on it than selling calls, right? And so, question might come up, do I sell puts? Absolutely. When the markets tell me that the right way to trade the option is to sell a put. And of course, it's got to be on a stock that I think I would like to own in the future if it did go down, right? Again, more on that later. So if you take yourself past the calls and puts, there's basically three things that I want to talk about in details, and I'll keep them very quick. Number one, 1 equals 100. 1 equals 100 is a contract size, so one call option is good for 100 shares of stock, right? There are a few places around the world where one contract equals 1,000, but for most of us, 1 equals 100, especially if you're trading stocks in the US. That's the first detail. The second detail is the strike price, right? A strike price is the price agreed upon between the buyer and seller, and that's the price the buyer can exercise the option contract for. Now, most of us don't do that, okay? The only folks that I know that are in the business of buying options with the idea they want to exercise the stock are more longer term holders. Maybe they're leap traders or traders that take long-term options. Most of us buy call options with the intent in selling them higher, right? Which leads me to detail number 3, and that is expiration dates. Now, expiration dates are all over the place on the map. So, you could look at, for instance, to me, if I were to walk these down, as you see here, third Friday options, most liquid, absolutely most liquid. We're in the third Friday week this week, right? In fact, we're in a triple witching month because we are falling into, last month was triple witching, excuse me. We are in a third Friday, most liquid. The next most liquid would be the weekly options. The options expire every Friday. Then the volatility and volume drop off. Monday and Wednesday options, there are EOMs, those are called end of month options. There are quarterly options, which happen at the end of every quarter. And then there are leap options, which is basically an option that has 9 months or more to expiration. The question I get all the time is, which is the best option to trade? And the answer I'm going to give you is yes. Yes, because it really depends. It depends on whether your outlook is short-term or long-term. It depends on whether you have the time to trade short-term options. All right, if you're trading options and your intent is to get out 4 hours after you get in, obviously the weekly makes the most sense. But if you're an option investor and you're looking at buying options and putting that trade away and not looking at it for 6 months or longer, then a leap option might be the best thing to do. What I want to walk you through tonight is not picking options because you think they're going to go higher. I want you to use options as the last resort to spotting opportunity, okay? We want to spot the opportunity when we look at price and time, so that then once we line up price and time, the option expiration date will be very clear, right? So the only other definitions I want to go into is I want to talk a little bit about in the money, at the money, out of the money. And these are definitions on where the option is. If it's an in the money option, it has mostly real value, right? If it's an out of the money option, it has no real value. If it's at the money, this is where the stock and the strike prices are exactly the same or very close. The option will have no real value, but it does have the highest chance of becoming an in the money option, right? Because it's right there. Now, the next piece of detail I want to talk about is the time decay. As a buyer of options, we have to deal with this graph right here. The farther out you buy, the less susceptible you are to time decay. if you buy an option with on Friday and its expiration, you buy it Friday morning and its expiration is Friday afternoon, it has the highest amount of time decay in any series, a 30, a 60, a 90, 120, 150, 180 day option. If you do buy something that's farther out, you'll know that it takes longer for that time decay to happen. Time decay is kind of like a snowball. The closer you get to expiration, the more time you lose on a per day basis. Now that's with at the money options. Take a look at in the money options. In the money options actually have lower time decay. And that's because they are a mixture of real value and time value. So I don't want to get too deep into this, but let me tell you what I like to do. I like to be a buyer in a lot of cases of in the money options, and I like to be a seller of at the money. All right, but a lot of that has to do with the next piece, really the last piece of information I want to share with you on options as we go forward, and that is volatility. Now, volatility is the speed of a stock relative to its time. And there's two types we look at when we predict stock movement. Statistical, which is basically if you look at Bollinger Bands, or you look at average true range, or you look at indicators like this, they give you an idea of statistical or past stock movement. Implied volatility is built into the time premium of the option itself, and it gives us an idea of where option traders see the stock going in the future. So I want to show you two ideas of volatility, one that most people look at and one that very few people look at. Most people look at something like this. This is the VXX or VIX, the VIX. And you can see back here during coronavirus, all right, during the coronavirus month of March, the VIX and VXX were trading very high. In fact, this thing is typically trades down below 20, and yet near the end of March, it was trading as almost as high as 80. Well, it snapped back down and currently trading in the low 20s because right now things seem to be calm. So maybe you've heard that adage, when the VIX is high, it's time to buy. When the VIX is low, it's time to go, right? That is based on the overall market, something a lot of people understand, or at least they have heard about it. Maybe they don't understand it. But this is a measurement of volatility. Now, this is a measurement of volatility that most people don't look at. This is volatility that we capture on tomsoptiontools.com. And so the volatility here, this is the SPY. And you can see this is a 100-day chart going back to the end of May. And you can see how the S&P went up and then it dropped down real hard. You can see volatility was going sideways. It actually came down a little bit. But look what it did right before that drop, spiked up and then boom. And if you notice, left hand is the stock price, right hand is the actual 7 to 30 day at the money IV for SPY. So we actually chart and we build models on each stock's implied volatility number, so we can see whether the stock is expensive or cheap. And if you're looking at SPY as of this chart, you might be looking at this and saying, all right, where's the cheapest it's been? Down here around 14. Call it 15. Where's the most expensive it's been in the last 100 days? Well, all the way up here on June 11th, and that was when we were at 36. So it's safe to say that option premium was twice as expensive back here, all right, on June 11th as it was as we came into the beginning of September. Look where it is now. It's trading just above 20, and you can see just above 20 is not at its low, but it's not at its peak. It's slightly undervalued, but very close to trading really middle of the range. But that's what we look at. So again, I'm going to ask the question, what's the best option trade to take? Let's say on a call option, for instance. Well, when you add in volatility, this is what I like to look at. First, if we are less than 30 days, let's start over here. Less than 30 days, I like to buy in the money options that have a delta of 70 or better. You know why? Because I'm trying to keep myself out of the time decay game. Number two, if we're in the 30 to 60 day or the 30 to 90 day realm, then maybe in the money to at the money options might make sense because I have less time decay happening during that time frame. And if I'm at 90 days or more, well, then I have a lot of time on my side, so buying the at the money to even out of the money options might make more sense because I'm giving myself more time to be right. And remember, this is on low volatility. So you can imagine if you replace this with high volatility, this is going to change. And it's going to change into something like spreads, which we'll cover next week, right? Long puts have the same characteristics as long calls, but in down markets. So they have the same 1 to 100 contract size as calls. They have the same number of strike prices and expiration dates, but puts increase in value as a stock price decreases. So at this point, I want to stop right here for, let's call it 2 minutes, 2-3 minutes. Jay, are you there?
Yes, so
can you scan the boards real quick and see if there are any popular questions that have to do with options themselves before we move into our first round of trades?
Not options specifically. We've had a couple of folks mention that they are trying to find the best list of stocks for weekly options, and I told them that's part of the process and going to come over the next 3 weeks.
Yeah, absolutely. And so I want to share something that everybody in the room can do. All right, you really don't need, one of the things I want to do is, my plan here is to really try to educate you as much as I can. Yes, I've got proprietary stuff. That's all great, but I want you to be able to X and O it yourself. All right, and what I mean by that is be able to understand how to spot opportunities and how to create low risk trading opportunities, and then execute, plan, execute, manage. So we're going to start that with something I call the 1030 MA cross. Okay, because this is actually a pretty powerful little tool that anybody could use, because you can find a 1030 MA cross on just about any good, decent piece of software, and there are many free ones out there that will do this. Right, so we'll talk about that. We'll talk about how to create a low risk trade, and I've got a whole slew of opportunities tonight, but we're going to narrow them down because I like to also try to put stuff together and layer things. So we'll do that, and we're going to do that right now. So what is a moving average crossover? Well, a moving average crossover is when you take two moving averages that are different lengths on the same chart. Okay, the short-term moving average is going to be more reactive than the long-term moving average. And as the stock market gyrates up and down in the stock itself, these two lines will cross back and forth. So I'm just going to throw some older charts up on the screen so everybody understands what moving average crossovers look like. Here's Tesla, right? Tesla moving average cross. And you can see the stock starts moving higher and higher and higher. And this is an example of the 50 over to 200. Right now, the 50 period moving average over to 200. These are great, but I call these longer term investment tools. If you're a short term trader, the 50 and 200 can be too long. And so that's why we use that 1030 cross, which happens to be my mentor's favorite indicator. Yes, that is me on the right hand side. That's me. Wow, so many years ago. I want to say that was 2005. I mean, that's 15 years ago, 2005. I had more hair on my head, less coming out of my ears and my nose. But anyway, my mentor, George Fontenelle's there with me. And he used to always follow this 1030 crossover indicator. The 1030 crossover indicator was actually really simple. It's when the 10 simple day moving average, the 10-day simple moving average crossed above the 30, that was bullish. And it was bearish when the 10-day simple moving average crossed below the 30. So bullish when the 10 went above the 30, bearish when the 10 went below the 30. Now, these crossovers, for those of you that use our tools, they're found in our tools, right? And they're actually found very easily. I'm just going to show you real quick where you'd find those. We're going to go to tomsoptiontools.com. I'm going to log in real quick. And then if you go right here under Option Trader, right there, click on the crossover image, and that'll move you there. We're going to get there here shortly. I'm going to go ahead and click on it and get ready. So we're going to go and get ready, and I'm almost ready to go there. We're going to come back to this here momentarily. So the way this works is moving average crossovers. In the case of the 10 and the 30, the 10 goes down, this is bearish. When the 10 crosses above the 30, that's bullish. 10 crosses below, bearish. You get buy signals when they cross above, you get sell signals when they cross below. Moving average crossovers, this is what we call a trend trading strategy. It means that when the trend is your friend, and when it's moving in your direction, the signals do not cross. And signals that don't cross for a long time are very, very profitable. Second thing I want to mention is that they work in both bull and bear markets, right? Here's Lululemon going up, and here's Lululemon going down. And then the things that I want to, kind of remind you about is that, not every stock works with this. Okay, I like to say that stocks come and go with this system. As they calm down, they don't work as well. And it's a 60 to 90-day strategy. So what you're going to be looking at is using near money options or spreads. But tonight we're going to actually just look at call options on 1030 bulls. All right. And so what we're going to do is we're going to take this from an indicator to a system, or at least a scan. Let's call it a scan. So if you remember this, all right, where I'm looking at this moving average crossover piece, let's get on over there because this is what I'm looking at right now. I'm actually it's already set up for me. The 30 is my long, the 10 is my short, and what I'm looking for is in the S&P 500. That's some of the most liquid stocks around. I'm going to run this scan, and I'm going to get a list of bullish opportunities just by clicking on the search button. Tonight, it's 10:14. So let's click on that search button, and let me grab those opportunities. And here's what I've come up with. So for 10:14, I've got all kinds of opportunities that are on bullish stocks. The one at the very top is Hormel Foods, right? Shows me the stock, even gives me an idea of a call option, that at the money call option. Now these are shorter term, and I can move around this date a little bit more. But look at this screen and look at the list we have here. So we got Hormel, Clorox is on here. Moving along, I've got Kraft Heinz. You remember that company that Warren Buffett got killed on? Well, guess what? It recently has a 1030 crossover. Facebook is on here too, right? JB Hunt, Chubb. I'm looking for stocks that we all know well and good. I mean, there's most of them on here we should all know well and good, but there's a few that pop up that really pop up more than others. All right. So what do these stocks all have in common? Well, they all have that 1030 cross happening. So, let's start for a moment with, if I come up here to the top. Now, these are ranked. You see the way we have them ranked up here? All right. These are ranked by which ones did the best today. So if I come across, I see 3M right here. So I'm going to click on 3M. And I get a chart of 3M. And I see buy and sells that have happened in the past that look pretty good. Here's the buy. What I really like about this chart is it actually is moving higher. So I'm getting a bullish signal into a climbing stock. So let's take a little bit further look at 3M. Remember, spot the opportunity. So if the opportunities we're trading trendy trades, we're trading these bullish crossovers on stocks that are having higher lows and higher highs and making new highs. The trend is our friend, and it's telling us when to get in or when to possibly get in. In this case, I may want to go ahead and take a look at what's to come. Now, the other thing I want to mention is that the last earnings reports that have come out. So you take a look at the earnings. The earnings dropped over the following week after earnings. And in this case, it dropped 2 weeks before bouncing. So what I see is 1 week, 2 week. We want to make sure that we're at least 2 weeks past that earnings date. 13 days to expiration. So I want to be out there a month past this. So maybe with 3M, what I want to look at is potentially, and let me bring it up real quick, the option graph for 3M. Let's log in again. I'm actually going to bring up a separate chart just so I can go back and forth on these a little quicker than normal. All right, MMM is my signal. Now let me show you what I'm looking at here. These are all of the expiration months and weeks for 3M. So the October 16th are check mark. I don't want to look at those. They expire in 2 days. I want to let's look at the November 20th options. They expire in 37 days. That's a little more than 2 weeks past the earnings. So I'm going to click on that, and I'm going to slide over here. Now this shows me 3M, and I'm going to look at 20% above and below the strike prices, or the stock price. Here we go. I have calls on the left, I have puts on the right. Today's stock price close was 168.40. Let's take a look at the call options. So what I see here is I've got 3M 170 calls. I've got 175s, 180s, 185s, 190s, etc. Right? So if I go back and I look at that chart for a moment, and I see this thing kind of popping up, and I see the buy signal, and I see 145. How high what was the highest high after the buy signal? Well, it went to 160. Right? So that was about 10% higher. Here's a buy signal at 155 that went to 170, about 10% higher. This one was maybe about 5% higher. This was about 5% higher. So let's get in the 10% range. So if 3M were to move 10% higher than where we are right now, right, which is around 168.40, we're talking about 16 points. We don't even need it to go 16 points higher. How about we shoot for 180? Can we make money on an option in November with getting a target at 180? Let's go back to the stock and option table and look again. Well, the 175s are $3.73. So if we got to 180, those 175 calls would have a minimum value of 5. So we could look at making about $1.25 on that trade. If we looked at the 170s are trading close to 6. Now those would be worth 10 if we got to 180. So 6 could become 10, but no doubles. All right, but those are the trades that are worth looking at on 3M. But I'd say these are a bit pricey. Now, how can we know if they're truly pricey? Well, what we need to do is we would need to look at the actual stock table. Let's go back on 3M, and I want to actually look at the stock chart itself. All right, so here's the stock chart for 3M. Look at that. It's not cheap. It's actually going up in volatility. The highest it's been has been at 42. The lowest it's been has been below 22. Right now it's at 32, so it's not cheap. It's not expensive. Maybe we can find something that's a little bit better. All right, let's go back to our moving averages again. And let's look at Hormel. Hormel Foods, $50.23, showing me that the October 30 calls are going for 90 cents. Well, that's cheap. The IV rank, all right, what's the IV rank? You know what? When you look at this, and we're looking at these 30 to these 36-day options, I can see that in the last 100 days, we're sitting right in the middle, all right? If I look at Hormel, however, look where Hormel's options are sitting. If 0 is the lowest it could possibly be, and 100 is the highest it could possibly be, where do we sit with Hormel? We sit at a 10. That's incredible. 10% IV rank. That means that this is 10% off of its bottom. It also shows us the percent to double, and by the way, the lower this number is, the better. This is a percent to double is at 3.13. So this might be the best value trade that we see in the 1030 cross. Let's go ahead and look at Hormel. The symbol is HRL. Here it is on the chart. And you can see here, buy signal at 42. The high after that was 50 before it pulled back. Buy signal, nothing. Buy signal, really not much. Here's a buy signal at 48 that went as high as about 53 before pulling back. Buy signal here. Again, this one's climbing too. Support is getting higher. This is good. Earnings are in 44 days. That's good too, because we could look at the options that expire on November 20th, and we're out before the earnings. That means we will be out before the high volatility. And so that's why these options this month and next month, for most of the next month, look cheap. Right? So what could these look like? Well, let's go look at a stock chart or an option table. Here's an option table with Hormel. And the same thing, I'm looking at 20% up. I'm also looking at November 20th options. And I'm coming down and I'm looking at the calls for November 20th. And you can see here, we've got 50s. we've got 52.5, 55, 57.5, 60, right? So the 50 calls are $1.53. They're already 23 cents in the money. So most of this is still time value, but it's got some decent, it's slightly in the money, and it's only going to get better if the stock goes up. Now, how high? If I bought this 50 call for $1.50, how high would it need to go in order for me to double my money? Well, it need to go to 53, because if I could buy it for $1.50, it goes to 53, that option's worth 3. All right, so that's what we can look at with Hormel. All right, now I'm going to come back to Hormel because I've got something even better. I've layered up Hormel, and I want to show you it in its entirety. But let's look at one more. So let's go and look at, let's go back to our moving average home again. Let's see what else we got on here. All right, we've got Edward Life Sciences, we got United Airlines. The issue with United, I think Medtronic might be the best one. That's the second one on the list. It's also got a low percent to double. Clorox might be a good one too, but let's go ahead and look at Medtronic. So MDT has some decent slippage. It's got a low IV rank as well. And so if we look at MDT, here's Medtronic. Again, another stock that's getting higher and higher highs. It just came off of its highs for the year. All right, it's pulled back, but now we're seeing another, that 1030 cross is kicking in. And if you look here, this stock is typically going up about, this is 7.5%, this is 5%, this is a lot. That's got to be at least 10% right there. But let's say 7.5%, right? 7.5% off of 107. So what we're looking at is maybe this thing gets to about 115. So let's use 115 as a target. Again, we're going to need to find some options for Medtronic. So let's go find an option table, and let me type in MDT, and I'm going to click on update. And again, I'm going to look at those options on November 20th. The reason I like those so much is that they're third Friday options, and they give us plenty of time. This is 37 days to expiration, right? So those November 20th options are right out there. They're in a nice sweet spot. If we update these, we'll see that the November 20th calls with stock trading at 107.56. Here you go. The 110 calls are $2.94. To get to 115, if we got to 115, they'd be worth a minimum of 5, right? So these would go up, risk 3 to make 2. Now, the 105s, you could be risking $5.40 to make $4.60. So that's closer. You could always put this in. Let's say you want to put the 105s in, and you're saying, all right, what if they pull back to $5? I want to buy them. This is how you do it. Now, again, November 20th, 105 calls. So let me go over to Street Smart. This is one of the brokerage firms I use, MDT, and I'll set this trade up, show you how it looks. So I'm going to put in calls, and I'm going to select buy to open. Now I'm going to put a minimum in here of 2. Okay. The 105 calls. Oh, we want to look at 1120. That's going to change the strikes. And you see there's the 105s. They went 530 by 550, 540 in the middle. I want to put a limit order in of $5. And maybe I do that as a good till canceled, right? Preview the trade, and there's my trade preview. And I can place that order, but I'm not going to place it ahead of all of you. But you can see here, buy to open, 105 call. By the way, I'm going to say this again. This is not a recommendation. This is education. And what I look at doing is buying my options. I use limit orders. Some of them are good till cancel. Some of them I use as day only orders. And so the reason I put minimum of 2 out here was for, if someone asks what's a minimum options that I would trade, and my minimum is 2. Now, I trade in multiples much greater than this, but I'm saying minimum of 2 because of this. If I place this order and I get filled, the very next thing I'm going to do is this. I'm going to create a sell to close order, and I'm going to sell to close half of the exact trade that I just bought for double what I paid for it. So if I buy 2 of them at $5 a piece, I want to sell 1 of them for 10. Now I'm taking off half my position, and then I hold the rest for the maturity of the option. Okay, that's how I do that. Now, again, we were looking at several different opportunities using moving average crossovers. You can find moving average crossovers, and you put in the 10 and the 30 simple moving average on practically any piece of software will do it. Okay, I use my own tools because I have my own ways of scanning, and I can go in and type in everything from pennies and weeklies, which is a stock list that I've created. I can also say I want the slippage to be very low. That the slippage is the difference between the bid and the offer, okay, relative to the price of the stock. And so I can also put in deltas, and that gives me that in the money, at the money, out of the money, so that I'm really looking at stuff that's important to me. Days to expiration, I'll flex this back and forth. And then my maximum output will, I'll have that anywhere from say 25 to 50, depending on what I'm looking at. And of course, then I'll get a group of signals that look like this. All right. Before I show you the next round that I want to share with you, Jay, any questions on moving averages?
Yes, sir. I'm trying to find his name, but there was a question as to how you're determining that an option value is going to be $3.
Well, how we determine it's going to be, well, let's do this first.
I explained the real value, time value, but I figured everybody might want to.
So let's look at our MDT trade. I've just put it back up again. So right now, if this particular option closed today at 530 by 550. So that's going to be $530 on the bid and $550 on the offer. But if I wanted to put a limit order in at 5, so if I buy to open this trade, let's say I buy 2 of them, and I'm going to buy to open this at $5. We all know that that's what I want to get filled at. Now, the question you're saying is, how do I know it's going to get to 10? Well, I don't know it's going to get to 10, but how do I know what it's going to be worth if a stock gets to a certain price? That's called your minimum value. And so if we go back to MDT, let me find it on the chart here. Okay, so if MDT, the stock, goes up to $115 a share, which is our target on this trade, then if I have the right to buy it at 105 and it's trading at 115, don't I have a right that's worth at least $10? I can buy it all day long for 105, and I can sell it at the market at 115 if it's trading at 115. So that option is going to have a minimum value of 10. Right? Did I answer that correctly, Jay?
In my view, yes, and I would imagine that the student would type in yes as well.
Okay. Anything else before we move on?
Explaining close half the position.
Okay. So closing half the position is something that I do that actually takes a lot of the emotion out of my trades. Okay. I did this with some of the FANG stocks in my account earlier this week. All right. When Apple had that big push up to like 127 pre-open. This was what was it, yesterday, day before? The days are running together so much for me. It was right before the announcement. It was the morning before the announcement, and I went ahead and took off the majority of my position because, again, a couple of reasons. Well, that stock had gone up too far too fast ahead of the announcement, and the pattern with Apple is you buy the rumor and you sell before the news. And the news was Tim Cook coming out and teasing us with the iPhone 5G. Now that that's come back, guess what I ended up doing today, Jay? I got back into Apple today. All right, but I sell off by selling off half your position. If I buy to open, follow along with me here, 2 of these calls. And let's say I get filled at 5. All right, so 5 times 2 is 10, times 100 is $1,000. So the entire trade, if I buy 2 contracts and I pay $5 for each one, it's going to cost me $1,000 plus some small exchange fee. If I sell to close one of these for 10, I'm going to receive $1,000. Plus, I still have the other one open in case it goes higher, right? Which for some stocks, I have projections that could indeed happen much higher, right? So with that, let's move into my next piece I want to share with you here as we finish up the hour. And the spotting the opportunity is going to be the money calendar. So the money counter is not something you can just grab anywhere, like a 1030 moving average. This is something that I've spent years and countless dollars on. Stack of programmers. I mean, you name it. My programmers, and I talk them up, guys. These guys are ex-NASA, ex-Raytheon. They are the real deal, right? They are. I got one of my guys handled missile guidance, right? So he's pretty good on the math. And so we've got, and I also grabbed one that wrote the language for one of the biggest brokerage firms out there when writing language and code during that time was possible, right? So one of those guys is in the group too. And so what we've done is we've created this money calendar, which is basically, in a short note, it's a seasonal calendar, and we find the best start day and the best end day for all of the most popular stocks out there. We look at a minimum of 10 years worth of data. From there, we can then look at these trades where we try to find that as 1-to-1, 2-to-1, 5-to-1s. This is something that I have in the process of getting a utility patent for. And these things don't take time, and I spend a lot of time and money on this as well because it's worth it. But the money counter is in a couple of different parts. Part one is the overview that I'm looking at, and I get an idea of what's happening in the market overall. Part two is I get a detailed view of a list of stocks, and I can go and look at those stocks at any time. This is actually part of the detailed view of what I was looking at tonight. All right, so Intel's on the screen, Qualcomm, Walmart, FedEx. Hey, look at that, Jay. Hormel's on there too. What do you say? Not only do we have a moving average crossover, but Hormel is also on the money calendar. All right, that's not a coincidence, by the way. I wanted to make sure that everybody saw that. Step three is that I go into the details of each particular stock, and I can open those up, and I ask myself two questions. Number one, where's it going? And number two, how long is it going to take to get there? And I can find that out based on history. And again, history is just patterns. It's not a guarantee, okay? But I follow patterns. That's what I do. In good times and bad times, I follow patterns. I sleep on the left-hand side of the bed every night. My wife sleeps on the right-hand side of the bed. I know when I get up in the morning, I'm putting my feet down on the left side of the bed. It's just the way it is. Now, typically, I don't have, something laying down there like a shoe or, something hard I can step on that might hurt my feet. Typically, my pattern is I'm going to land flat on the floor, but every once in a while, I might step on something. Sometimes it might be cat food. And I say that because, here we've got 90% patterns. And although I find myself very comfortable getting into these patterns and getting out of them based on all the math and all the history I've done, there's no guarantee it's going to continue to work that way. But this is the way I'm going to continue to trade. So with Hormel, I'm looking at today to November 20th. It turns out that the actual pattern is between today and November 20th. And what I find is that this pattern has resulted in an average of around that $3 to $4 move. So I plan my option around step one. In this case, Hormel's trending up. We already saw that. Okay, number two, seasonality is actually up because that's what the money calendar is telling us. Volatility is low. We already know that too. My price target is somewhere between 53 and 54. So what's the best trade? So at this point, let's go back to Hormel and look at it one more time. So with Hormel, I'm going to go back and I'm going to bring up the stock charts. Well, we already saw the stock chart for Hormel, but let's look at it one more time. HRL. And I'm going to look at the chart and the volatility. Now, unlike our last chart, Hormel's chart, the high was up here right before earnings, and the low was sometime a couple of weeks prior to earnings. And you see the low down here near 20, and the high was up here in the mid 30s. And look where we are right now, low 20s. We're down near the lows of this particular chart. That means option volume's low. You know what that means? Option prices are going to be low. So then I go to the stock and options tables, and I got to type back in HRL. And I've got to go into November 20th because now you know why I like November 20th. That money calendar end date was November 20th. And I can see here that looking at these call options, the 50 calls, if I were to buy one, and let's say I were to get $1.50 for it, if we went to 53, that $50 call should be worth at least $3 in value. Now, I'm going to take this a little bit further. I'm going to click on a risk graph, and a risk graph is going to give me that visualization of where the stock is where the option is likely to go. If the stock gets back to 53, that's where it was prior to the last earnings announcement. Looks like it's kind of heading that way again. If we go to 53, this is where I'll be on the graph. I'll be out here at about $157. And that's what this is telling me this theoretically. If I pay $153 and I get $157 in profit, that's a little more than 100% return right there. The worst that can happen is it just goes down and I can lose no more than I put into the trade, right? So limited risk and unlimited reward, but it really is limited till we get, to the exit. I don't like to call this an unlimited reward. I don't know who came up with that theory, but it's something that a lot of option traders use. I call it unlimited until you're out. All right, but that's Hormel. Now, to place that order, and again, I've kind of already prepped this one for you because I looked at this one right before we came on. So HRL call option. If I'm following my rules, I like, for me, a minimum of at least 2. So that means 2, 4, 6, 8, anything even, so I can take half of them off. Here's the 50 calls, 145 by 160. If I put a limit order in at 150, good till canceled. If I'm filled on that, I'm immediately going to sell half at a double. That means half of 2 is 1, and double is 3. So if I'm paying $1.50 for 2 of them, and I sell one of them for 3, I'm basically taking my risk off the table. That's what that is. Okay. Jay, any questions on the money counter as we go look for more opportunities?
Well, this applies to money calendar and the 1030 and any trade. Any concerns about options expirations past election day? And does election day come into your considerations as to either?
Yeah, I did a lot of research on right before and right after election day, and that's kind of a hard one because there's no statistical data that says the market's going to drop really hard or the market's going to go higher. I'm telling you, depending on who you're watching, what channel you're watching, we're either going to fall right out of the right out of space, or the market's going to be at 36,000 Dow. In fact, a lot of the gurus out there have the market going higher regardless of who wins. And I think there's got to be a cooling off. But the problem is that, what I might think and the way I might trade are two different things, because I don't trade based on what I think the market's going to do. And I would not advise that anyone else would do so either, although I'm not your investment advisor, so I can't tell you specifically what to do. But all the research I show says that there's really no push one way or another. Now, if there is some new rules that come into effect, let's say if we get Biden a Biden presidency and we get a Democratic House and Senate, market might get a little spooked about that. All right, but there'll be opportunities. I'll tell you, I think the cannabis industry will rejoice. Electric will love it. Solar will love it. Anything alternative will love it because that's typically friendly. But I wouldn't let that worry you as an option trader too much. In fact, we're actually lucky as option traders because the fact that we're trading options in a lot of cases in place of a stock means we're hedging off a lot of that risk just for that reason. All right, so let's go look at money calendar and let's see what's going on with it. So I'm actually going to bring it up today. Here's the calendar. Yes, Jay. You sound like you wanted to say something.
Oh, no, I was unmuting myself here and all. No, that's good. I mean, the only other consideration is, use that as a time stop. If you've got to trade on and you're concerned about the election, just close out the day of or the day before.
Absolutely. Yeah. I mean, there was a guy I respect that was on Bloomberg today that said Friday is going to be the high, and then he said we're going to pull back for 2 weeks, and then we're going to get a new bull run. And this is one of the most highly respected guys out there. Another one is still looking for the bear market to come down. Big money manager. So I mean, it's really hard, and I understand that, especially to those of you that look for guidance. The best thing I can tell you to do, which works for me, mute the television and do the work like I'm doing right here, and come up with some solid ideas based on your own research and not what somebody else has to say. I got to tell you, every time I have that TV on and it clouds me, I'm either missing an opportunity or I'm screwing up something that I've got on. And I can't tell you 9 times out of 10 how often that happens. And I say to myself, wow, if I had just stuck with my position. And I don't do that often, but every once in a while, and I got to catch myself. So the best way that I do that is I got the TV on, but I can't hear what's going on. So there's no distractions. I'm in a soundproof room. I don't get distractions from my friends, my family, nobody. And so, I think that's sometimes the best thing to do is trust your own knowledge and your own instincts, and allow me to help you in terms of what we call non-emotional trading strategies. Okay, so here's the 14th. Let's go look at the 15th. So I'm looking at the 15th. I'm going to sort this by what's trendiest right now. So what's trendiest is AutoZone. All right, Lam Research, Adobe, Autodesk. These are the trendy things right now. Let's look at AutoZone for a moment. So AutoZone says that this is a bullish opportunity between October 15th and November 25th. When I take a look at some more details, I see, wow, look at this. Look at all this cheddar right here, guys. There was your losing trade. The only time this pattern did not work, stock was down $6.24. Look what happened in the other 9 years. 2010 up 25 bucks, 2012 up 10, 2013 up 31, 2014 up 66, 2015 42, 16 33, 17 64, 18 52, and 19 last year 73 points of the pattern. I'm actually going to click on the pattern. You can see it right here. Kind of a little bit of a move down, then boom, 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 up to new highs. And so that's AutoZone. Now, what is the problem with AutoZone? Because I already see it. Some of you don't. Let me show you what I'm talking about. The problem is, let me just go to Street Smart real quick. And again, AZO, AutoZone. You know what the problem is? It's $1,169 a share. So how much do you think that call option is going to cost? It's in November. Let's find out. November 20th, 27th is where you're going to have to go. The 1165 call, $47.70, $51.40 in the middle. We're talking about $5,140. That's $5,140. I think Jay will save this one for next week because that's a little bit pricey. So back to the calendar.
Spread category. Yep.
Back to the calendar. I'm not going to waste our time, but look here. You got ILMN. That's 100 again, and we're looking at stock. Trades stocks that are expensive. Autodesk. All right, take a look at Autodesk. I'm just going to go over here and start typing in symbols. Let's clear this. ADSK. K, not J. All right, $246. This might be okay. Let's back up a sec. So Autodesk goes all the way out to November 25th. 90%er, net profit $72. So we're talking about roughly $7.25 average, but I'll bet it looks better when you get towards the year. It sure does. Look at that. This thing's doing much better. I'd say we have at least a $10 move on this one. So let's go look and see first what the call options might cost us. All right, so if I'm going to buy to open, let's see what those, what was that calendar going out till? November 25th, same date. All right, so let's go to 11/27. 245. Ooh, $16.02. Now, stick with me here for a second, everybody. Why is this not a good trade to buy calls on? because you might be saying, Tom, I don't care. I'll pay the $16.02 to buy this. Well, if we get a move like this, $22.95, then that would totally be worth it. All right, it'd be totally worth it if we just ran up. Problem is that what if we get a move like that? $2.86. What if we get a move like $10.60? I mean, 10's the average when you look at this. So the problem I see is that I'm going to pay $16 for something that's only going to move 10 bucks. Then what's going to happen when it gets to $2.55? And if it takes until almost Thanksgiving to get to $2.55, my options are only going to be worth 10. If I paid 16 for them, I lose money. So a lot of times the calendar's got some great opportunities, but maybe the call option is not the best thing to take on. All right, back to the day. Let's go look and see what we got here. Should I even look at Royal Caribbean? Why not? You know, this was one of those ones where, I mean, look what happened in 2018. It dropped $12.23, and that was not coronavirus. And that doesn't even look like it was an earnings now. It was just a drop down before it finally fizzled out. But if you look at the average move, we're only talking about $3.57. And this is in a stock that's not really going up right. Well, I can't say it's not going up, but it's in one of those categories that's very volatile. Definitely not something you want to just be buying call options on, right? If I move down the slide a little bit more, I see Starbucks on here. I think that's a great election stock. Actually was talking about that in a recent video. Hey, how about A? All right. What is A? I think I know what A is. Let's go. I'm thinking it's Agilent Technologies. A, Agilent Technologies. So Agilent is a $105 stock. Let's go back and take a look at Money Calendar, and it shows also a November 25th move. A lot of stocks are kind of moving out there to November 25th as we get into close to the holiday season. So if we're looking at this trade, and we're seeing here, this is moving up. This is about an average of $5 on the move, especially in the last, last 5-6 years. So let's take a look and see if something can be had with Agilent. So Agilent Technologies, the 105 calls going out to 11:20. Now Agilent only has options that happen on the third Fridays, but the 105s are trading for $4.10. Right? Here's the problem I see. The problem I see is, again, let's look at the Money Calendar. Money Calendar says that last year this thing moved up $5.62. 2018, 307, and then 2017, 382. There's the loser, 2016, that was $1.43. Then we got a pair of sixes. Right, so if we add all these together and then weight in an average more towards what's been happening lately, let's call it 5. Then it's safe to say that the 105 call, the stock's trading at 105. If we go to 110, the 105 call is only going to be worth 5. So my $4.10 call could only be worth a possible 5. Well, I don't like that. Okay, so that brings me back to, again, the case studies that I showed you, the case study in Hormel. Why Hormel? Well, Hormel was not only cheap in price, it was cheap on the options. So I go back to Money Calendar, and I find that a lot of these tech stocks, a lot of oil, there's Tiffany's on there as well. These are stocks that are not cheap, all right, in terms of their option implied volatility. Microsoft's on this list too. The good news is, let's look at Microsoft, all right? Microsoft goes out to November 6th. Okay, so let's take a look at that. So if you wanted to look at, say, Microsoft, MSFT, and you were going to look at the call options that expire around November 6th, we've got November 6th is a Friday, so it happens to fall on an expiration day. Well, stocks trading near 220, the 220 calls in November, they're $8.68. And again, everything I'm showing you guys, these are all bullish opportunities. The problem is that I don't know if I want to go out there and throw caution to the wind and just buy call options on everything, especially with the price tags that are being offered at. And I say to you that because spreads might make the best sense. Okay? Spreads might make the best sense. So, for case studies, we saw a few of them tonight. But what I want to do is I want to have you follow the case studies and take a look at this. And I've got some of the, and I'm going to give you the PDF for the slides tonight, which include the case studies on both the 1030, all right, which you're going to find a lot more there that might offer call option opportunities, as well as some of the top ones we have for money calendar, right? So our homework for this week, and I got homework for you, okay? Because we're going to continue this discussion next Wednesday. Same time, same channel. But I want you to follow the case studies we discussed tonight. I also, between now and then, if you want some great videos, and I know a lot of you know where to get this, our YouTube channel, youtube.com/Tom's Trading Room. You can get some free education right out there. These are basically 10 to 15 minute videos on either specific stocks, specific strategies, or the overall market. So again, guys, thank you very much. Optionetics students, I love you. Glad to have you here, and I will have a recording out for all of you sometime tomorrow.